Welcome to the Daily Update, where I'll go over the action in the market for Friday, December 1st, and then we'll see how things look for Monday, December 4th. We had another update, wasn't really strong, getting a little bit concerned because value is really outperforming growth right now, but technically we are showing some improvement. In the short and intermediate term, we're a little bit more overextended to the upside. But the good part about what's happening right now, if you're long the market, is that we're not seeing an awful lot of selling into strength. It's pretty choppy, but we're not seeing any real strong selling that's really driving things lower, which we could do when we get to an overextended condition. Now, we're in kind of a choppy part seasonally, but once we get through this, about the middle or so of December, we start to turn more positive on a seasonal basis, although things are remaining positive for right now. So let's go back and talk about what happened. Right at the open, we had a choppy open. And just like I pointed out in Friday's video, the bars are really quite wide. We're seeing a lot of back and forth going on. And prices moved between the daily pivot at 45.58 before breaking into positive territory. So we actually did have a bit of a lower open, but then we shot up out of that. As the day went on, we climbed up to R1 at 45.79. We even went above R2 at 45.91. And then we hit this psychological level, a round number, also a lot of strike prices for options, at the 4,600 level. We're just a tick or so away from hitting that. And that seems to be the next level of overhead resistance, at least from a psychological point. Then prices fell back below R2 before climbing back and closing near the intraday high above R2. We were up 0.59% on above average volume. So we're starting to see that be more consistent now. We are positive technically, but in the short intermediate term, we are overextended. And every day we go up from here without any kind of a meaningful decline, we become more overextended to the upside. Now we can keep going, and that's what solid momentum can do, but also be aware that we might be getting a little bit exhausted at some point. It's about inflation, interest rates, and there was more Fed speak in Friday's session that I'll go through. It's earnings as they are released, and then of course keeping an eye on what's happening geopolitically. Some comments. The S&P did hit resistance at 4,600, just a little bit under that. The broad market is continuing to show improvement, and that's actually outperforming the mega caps, which is positive. When you see all of the stocks participating and some of the weaker areas start to show some improvement, that's suggesting that things are turning more positive. Then we had Fed Chair Powell. He gave a speech, but he didn't really say anything new in that speech. His quote is, "It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate when policy might ease." That just means they could still raise interest rates if the economic reports are strong. If the economic reports stay where they're at, they're probably going to keep interest rates where they're at, but they're still looking into the future, thinking that the market is anticipating that there will be policy eases going into 2024. Oil did close down at $74.07. And we have our short-term list here, which we have the short-term ADX. That's still above 40. That's a little bit extreme. We have not got to that point yet with the intermediate term indicator, but this usually happens first because it moves quicker. We have the advanced decline ratio starting to get extreme, the 20-period exponential moving average study, the Stochh RSI, the Williams percent R. We do have the CCI 14. That's back on the list. The CCI 20 is not quite there yet. The stochastics on all three different time frames. The PMO oscillator, the boom indicator, is now back on the list. The RSI based on 9 periods and the slope oscillator, which is actually starting to come down, but after giving us an extreme positive reading. Intermediate term, we now have the 50-period moving average study that is starting to get extreme. So we're showing a little bit more overextended upside movement in the intermediate term. We have both the S&P 500 and the NYSE McClellan oscillator that are starting to get extreme. The PMO studies, the Sean trend meter, the RSI based on 14 periods, and the TTM squeeze, as well as the NASDAQ 100 bullish percent index, the advanced decline ratio that we use based on 19 periods, and the new high, new low study based on 10 periods for the S&P. And I have charts to show you all of these different things. And I'm trying to underline this to make it a little bit easier to read. We're still dealing with the same basic scenario that the Fed is keeping rates higher for longer. That's what they said they would do. That's what they're doing right now. But then the speculation comes in. If we see some strong economic reports, that may entice them to raise rates. If we see weak or economic reports that are kind of where we're at right now, especially we're going to get the employment situation coming out in the upcoming Friday. And if that comes in weaker than expected, the market may really like that, thinking, oh, they're going to start cutting rates here pretty soon. We're also keeping an eye on Israel, oil, and then earnings as they are released. The dollar was down and interest rates were down, and both of these together gave some support to stock prices. The 10 to the 2 and the 10 to the 3 month, which in my opinion are the most important yield curves, they are still inverted. Sentiment is still positive at 67. We ticked up from 66. It's when we get up to about 75, that's when we're looking extreme. And our trend is still positive. The ADX is above its moving average, both in the short and intermediate term. The short term, as I said, is looking a little extreme. The intermediate term is still okay and trending higher. And the green line is definitely on top. Our momentum, which usually means just one day, that is positive. I'm sorry, our bias is positive. That's one day. And our momentum is usually the last 2, 3, 4, 5 days taken together. That is also positive. Some economic reports that came out, not really influential, with the S&P Global U.S. Manufacturing PMI, the final reading. The thing to take away from this is we're under 50. When it's 50 or below, that shows a contraction. When we're above 50, that shows expansion, and we came in at 49.4. This was the big one, the ISM manufacturing. It came in less than expected at 46.7. They thought it was going to come in at 47.5. Last time it was at 46.7. So the same reading that we saw last time. Construction spending really shot up more than they had expected. It was up 0.6%. They had expected 0.3%. Last time it was up 0.2%. Here are some charts where we have the ISM index. The blue line is the total. And that just shows that it's really hard to see on here. The lines are on top of each other, but we're above 45 and at least going sideways for right now. We did see a little bit of a tick up in orders, so that could be good economically. Then when we look at prices and deliveries, the prices are showing a bit of an increase where the deliveries actually declined slightly. Then the trade with the imports, that's the gold or yellow line here. There was a decrease as well as being a decrease in the exports. And then when we look at this on a bar chart here, we are pretty much the same from the last reading that we received. So the market liked that. When we look at construction spending, this really shot up on a year-over-year basis. We're up over 10% now, and that could be healthy economically. When we look at private construction, we first look at the blue line, which we're seeing an improvement of residential construction. We're actually turning down just a little bit with non-residential construction. And then month over month, it did increase, but it's showing a little bit of an improvement, but not as high as some other readings that we had been getting in 2023. We did fall a little bit with the 10-year yield. We're at 4.23%. If we can get under that 4% level, that could really help the market, because then that means that it's not necessarily biting into earnings. Here's our intraday chart where we were chopping all over the place. We actually had a lower open, but you can see the bar was just massive. There's a lot of back orders that had to be triggered right at the open. We came down to the daily pivot, and then from there, we went up to the unchanged level, came back down to the daily pivot. This was very choppy, but then eventually we broke into positive territory. We were able to get above R1, R2. Right here is 4,600. That's where we topped out, just a little bit under that before falling back down and then closing slightly above R2. Here's our intraday chart where we were actually more negative as we got closer to the open, and then things turned positive more in the session. And then we saw a little bit of a tick up as the futures closed for the weekend. But this is a little bit of a concern. We're continuing to see value outperforming growth. Value is the red line. The blue line is growth. And when we look at the growth to value ratio for the S&P, that was actually down. Again, in a good, solid environment, we want to see this going up. But you can also spin this around more positive. that it's a lot of the value stocks that have been hurt in 2023, and the fact that they're doing better just helps the whole broad market look better as well. Some end of day charts where both growth and value were up, but for the large caps, growth underperformed. We were up strong with the mid caps and the small caps, but they did underperform with the mid caps, and they also underperformed with the small caps. Over here on the left, this is value. Over on the right is growth. And then in the middle are the ETFs that we track to go along with this. But this is also a little bit of a warning sign. We're seeing the growth to value ratio and the end of day chart continue to decline as the market has been going up. Then looking at small cap growth to value, small caps were up strong, but the growth to value ratio actually went down. It's still in a longer term uptrend, but more or less has been chopping sideways since last spring. The mid caps also holding up, but did decline, been chopping sideways, still in a longer term uptrend. Then I haven't shown this in a few days. We look at the equal weight discretionary ETF. That's in the second area here. Then we have the staples equal weight ETF. And then we compare the two by doing a ratio where discretionary did start to turn up against staples. And that's positive. That's more growth oriented. We're not really breaking out yet, but it is showing some improvement. Keeping an eye on our trend. Here's the intermediate term trend with the ADX above its moving average, the green line's on top and advancing, where the red line is declining. We're not really worried about that so much yet. But in the short term, the ADX is now breaking above 40. Now it can go above there and even stay here for a little while. This is just something we want to be aware of. Volume is starting to pick up. We're seeing above average volume, and that kind of helps just show that there's more conviction in the market. Looking at sentiment, we might still be in this choppy sideways time with the VIX before we see it decline. That could be positive after we get through this period. The Ulcer Index is suggesting that there's really no fear in the market right now. We did see the VIX with the line chart go down as well as the bar chart. So volatility and the fear gauge here is very low, showing a lot of complacency. The VIX of the VIX with the update also did decline. We're back under the moving average with the bar chart and the line chart. We're continuing to go down with the VIX to VVIX ratio. That is longer term positive. And the VIX to 3-month average of the VIX is also declining. That's also longer term positive. We continue to really go down as far as the VIX to move ratio, showing that stocks are less volatile than bonds. And we finally got an updated chart here. Actually, this is not an updated chart. Okay, I thought it had updated, but apparently it had not. I don't know what's going on with this. All we can look at now are just some recent readings here where we have been seeing the longer term equity put call ratio start to go down. And then we have the 5-period moving average, which is continuing to decline. Then looking at the 253 period, that is also continuing to decline. This other fear gauge that we follow is also declining. We're coming back down to these previous lows here. We'll wonder if that's going to offer some kind of support as far as measuring fear. And this other fear gauge that we follow is also continuing to decline. When we look at the risk on to risk off ratio, we are seeing some improvement here, but we want to see more follow through. We want to see this ratio going up. That means folks are buying more stocks. They're more in the risk on category. Looking at our advanced decline line studies, we are really advancing nicely based on price and volume and well above the moving averages. We're kind of topping out with our 5-period. We're turning back up with our 10-period. We saw a nice little breakout of the new highs, but that's not really reflected in our 5-period moving average. But as we start to break above resistance levels, we're going to see a real expansion of the new highs. And we're starting to get a little extreme in the short term with the blue line. That's the 19-day exponential moving average of the advanced decline ratio. They're both still positive, and this can go a little bit higher than where it's at right now. We just want to be aware of this. Accumulation distribution is still looking more positive. It's turning up above an advancing moving average. We are coming back down just a little bit with the Chaikin money flow after getting a really strong reading, but this is still pretty positive overall. Showed a real improvement with the cumulative NYSE advanced decline line. We broke well above this trend line, and we're also showing some improvement with our regular NYSE advanced decline line. Also seeing some improvement here. If we can stay above it and really start moving higher, eventually we might see a golden cross with the trend of the advanced decline line. And we're seeing a breakout when we look at the NYSE common stock based on price as well as volume. So they're confirming each other. When we look at our advanced decline line study, showing a lot of improvement with the NYSE common stock, the S&P, the mid caps, and even the small caps are showing a little bit of life. Our short-term charts here, we're coming right up to this red line that I have here. That is acting as overhead resistance. That's the 4,600 level. But when you take all of these bars together, they're still looking pretty healthy. That's for the most part, a series of higher highs and higher lows. On the bottom, even though we dropped off from Thursday's action, we are above average with volume. Our 20-period exponential moving average is getting extreme, as is the 50, where the 200 continues to advance. The boom indicator based on the 20-period moving average, that means we're getting a little far away from that 20-period moving average. It's starting to break back above 100. We're not there with our distance away from the 50-period moving average, and it's continuing to go up. And our 200-period moving average is also starting to go back up. So this is looking positive, but in the short term, a little extreme. The Stochc RSI, it's been extreme positive all week and continues to be so, as does the Williams percent R. These are our short-term, more touchy indicators. The CCI 14 is starting to break back above 100 now. It could still go higher than where it's at right now. We're seeing some improvement here with the force index. In yesterday's video, I pointed out that we were still positive, but we dropped below the midpoint. We're now crossing back above the midpoint. But we're still extreme when we look at the short-term, intermediate, and long-term stochastics charts. And we're getting up above the +3 standard deviation, but we've been there for quite a while now. The fact that the market isn't really turning and going down does suggest that things are positive for the time being. Some intermediate term charts, we're going back up with the balance of power. We're above the midpoint. That's positive. The go, no-go system, it's kind of redrawing some different colors in here, but when we see the dark blue, that's positive. We're up near the upper highest high value here, and that's starting to go up. That's improving and looking positive as the midpoint continues to advance. And we're coming down with the TTM squeeze. This is still positive, but it hasn't started to turn and go back up yet. This is kind of a warning sign that we're keeping an eye on. We'll see if it drops down below this black line. What will it start to do then? Longer term, where we had a really extreme positive reading, that matches up with another reading we saw back in 2022. This produced a stop and a reversal here, where we've been drifting more or less sideways as we've been seeing the extreme reading lately. The ease of movement is pretty much flat right now, but it's still positive since it's above zero. And the Erin indicator continues to go up. You could start to make a suggestion. If we go a little bit higher than this, we could be getting to an extreme reading. The green line is on top, that's buyers. The red line's on bottom, that's sellers. And this measures the difference between the two. We're starting to get extreme again with the S&P 500 McClellan oscillator. But when we look at the summation index based on price and volume, we're continuing to advance. We broke above this trend line. Now we're wondering, are we going to come back and match some of these previous highs? The NYSE McClellan oscillator just barely into this extreme positive territory, but showing good momentum for the time being. We are advancing with the summation index for the NYSE based on price and volume. The Swenlin trading oscillator is starting to turn back up based on price. It's going up just a little bit based on volume. The PMO starting to break above this red line, looking a little extreme, but we're still positive based on price and volume. We're getting back extreme with the PMOs that are rising. We're actually coming down, but still extreme with the buy signals. And we're just underneath this extreme reading with the PMOs that are above zero. We continue to be neutral, though. Even with this upward movement that we're seeing here, the Elders Impulse system still has the S&P at neutral. But we're still positive with the parabolic SAR since the dots are underneath. The slope oscillator, that's our short-term oscillator. It is continuing to decline after getting a really strong high reading. And the MACD is rolling over just a little bit, but it's still positive. So we look at all of our oscillators. The slope oscillator is coming back down. We're looking extreme with the TSI, rolling over a bit with the MACD, the PMO, the PPO, but they're not negative yet, where we're starting to get extreme with the TRIX and the KST. The KST is rolling over slightly. The Sean trend meter is back above the red line. That is in extreme positive territory. We're above all of the plotted moving averages. The longer we can stay here, the more these lines will start to be more straight and thin out a bit. The bullish percent index continues to be strong. Had a nice advance in Friday's session, and we're not at an extreme reading yet. And the NYSE bullish percent index continues to advance, is above 50 and looking positive. We turned down just a little bit with the NASDAQ 100 bullish percent index, but we're getting kind of an extreme reading. We'll have to keep an eye on this. If this drops below 70, that would not necessarily be a sell signal, but that would be an official overbought signal. The Chaikin oscillator, after it had been declining, is now starting to turn back up and is above zero. That's positive. The money flow is ticking up ever so slightly after giving us an extreme positive reading, but it's still positive. The ultimate oscillator is turning back up and is looking positive. The vortex, the green line, starting to go back up. That's looking more positive after giving us an extreme reading. And the RSI 14 is just barely above 70, where the RSI 9 is a little bit more extreme positive. On balance volume continues to advance above an advancing moving average. And we're showing a lot of improvement with our 200 period and 50 period moving average study of stocks in the S&P 500. The Copic curve, though, is now generating a sell signal. And here's a longer term look. After we had a pretty extreme reading here, it's not uncommon to see this start to turn down. If we see more follow through upward action, we'll be waiting to see if the Copic curve is going to turn back up. I only have the line studies here where we're getting back above this previous high and able to close above this for right now. We're wondering, are we going to go back and try to test the July 31st high? That would be the next level of overhead resistance. Our different charts, we're still looking good on a trend basis with the Heikin Ashi. We were a little bit concerned. We started to see some doji candles in here, but this is looking more healthy now. Where the Kegi, it had been pointing down, now it's starting to turn back up. That's positive. The Renko chart is still positive with open boxes, and the 3-line break is open candles, so that's positive. Then we're not seeing any changes yet with the Zohorchak method, so we're keeping an eye on this. If we see more upside movement in the market, we're going to be wondering if this is going to go up and give us a more positive signal. And then this is the weekly chart of the MACD for the S&P, where we've had 2 weeks now above the moving average. So longer term, the momentum and the basic trend is turning more positive. We did see a lot of improvement with the equal weight index. It actually outperformed the big stocks, but it's still underperforming longer term with the S&P 500. And we saw a real drop off in the ratio between the S&P 500 and the equal weight S&P. That is just suggesting, not that we're going down necessarily, that just means the broader market is showing some improvement. We did see a real move up with the Dow. We saw a bit of a move up with the transports and utilities. It's like everything went along for the ride in Friday's session, but the transports are still underperforming the Dow on this chart. We're starting to come back down slightly, but we're chopping around with the Dow to transports ratio. We want to see this fall for the transports to be outperforming. But when we look at the transports to S&P 500 ratio, that is really spiking up, but we've been seeing a lot of choppiness lately. We want to see this continue to go up to turn more positive with this ratio. The Dow is still looking pretty healthy and having some pretty good days, as of late anyway. And the diamonds, they've actually switched from being neutral. Now we have 2 days of being positive with green bars. We're above the pivot point here where the NASDAQ, it didn't really break out like the Dow's been doing lately. We're watching some of these previous highs, wondering if they're going to provide overhead resistance. We're still above the 61.8% retracement level. So we're in no man's land for right now. I'm just showing this chart in case we do start to see some weakness. We'll be watching this area for support. And the NASDAQ 100 didn't have that much of a stellar day itself. It's still above this pivot point right here and back to dealing with this previous high, wondering if that's causing some overhead resistance. And we continue to be neutral with the QQQs. And when we look at momentum, though, longer term with the NASDAQ 100, the PPO is starting to roll over. And so it shows that momentum is at least getting weaker. It may not be turning negative, but it looks a little exhausted. Looking at the small caps, they had a really good day. They were actually able to break above their 200-day moving average and close above this pivot point. But we've seen stuff like this before. They have these really monster up moves, and then they spend the next 3 or 4 days giving it all back. Are we going to see some more follow through with the small caps in the upcoming week? Looking at the Russell 2000 small cap index, we're starting to get extreme with the RSI. We're above the 200-day moving average based on price, but we're still in a longer-term downtrend. The shorter-term MACD is showing good momentum. And we're back over to positive now with the Elders Impulse system for the small caps. And we're really showing a nice little breakout here with the mid caps. They were able to stay above their 200-day moving average. And they're also positive with the Elders Impulse system. And the financial sector is showing some improvement after giving us a recent golden cross. This is looking much better than it had been for most of 2023. And even the micro caps were up and we're breaking back above 100. We're coming up to the 200-day moving average, which may end up acting as overhead resistance. The FANG index was actually down on the day. It has been a stellar performer as of late, been going sideways and then ended up closing lower in Friday's session. And we're still dealing with this previous all-time high here. We just can't seem to get above that and then close above that previous high. The dollar was down slightly, even though it's still in a longer-term uptrend. Bonds were down with the 10-year yield. We were up with the 10-year based on price. We've come right back up to the 200-day moving average. The longer-term momentum is positive, and the RSI is also positive. And we're still seeing this crazy thing. We're at 0.12 now. This continues to go up, suggesting that there's some kind of strangeness going on. I'm not really sure what it is. We're just keeping an eye on this and being aware of it. An update of our possible positive scenarios. We actually declined below the moving average when we compare the Qs to the S&P. We ticked up a little bit with discretionary to the S&P, and large cap growth did drop below the moving average when compared to large cap value. We also turned down with the large caps, mid caps, and small caps. So growth is not really kicking into gear. It's more value that's leading things right now. We are extreme with our 10-day average of the S&P 500 highs minus the lows. We've been camped up here for a few days now. Sorry about that. I had to hit the pause button. I've never done that before. Usually I record these all the way through from beginning to end, no matter how many coughs and clearing my throats and so forth that I have to do here. But I couldn't avoid having to pause it this time. All right, when we look at the broad market of the Amex, NASDAQ, and NYSE, we're still above zero when we look at the 5-period moving average of the highs minus the lows. We've been there for a few days now, so that's turning things more positive. Then looking at the 50-period exponential moving average of the new highs minus the new lows, this is continuing to advance. That's also longer-term positive. And the indicator's starting to really move up more, which is also drawing the red line, which is the moving average we use on the previous chart. That's helping things to improve in the broader picture. And the 2-year yield, it is starting to come down. It's spiked up and has been declining. Often that gives short to intermediate term support to the S&P. At least that seemed to help on Friday. Then when we look at the Staples S&P 500 ratio, it did decline slightly. Longer term, it's also declining, which also can give good support to the S&P. We're starting to get extreme with our 19-day exponential moving average of the advanced decline ratio, where we're getting a pretty high reading here. This is not necessarily one of those indicators where we camp out here for very long. So this might suggest that we're looking a little overbought. We're not quite getting an extreme reading based on volume. Then I haven't received the latest information from Tom Bowley yet. As soon as I get that, I'll swap this out and put the new chart in here. So what's our outlook for Monday? We are dealing with earnings. We're dealing with geopolitical events. The technicals, I haven't changed this in over a week now. We're positive, but we continue to be overbought. We're still wondering if there's some kind of weakness that's developing, but we're seeing no follow through based on price. We will get factory orders in Monday's session and then keeping an eye on what happens over the weekend. Here's the economic calendar for the upcoming week. On Tuesday, we're going to get the ISM non-manufacturing PMI. That's pretty important. And these other reports are important, but the big one is going to be on Friday when we get the employment situation report. Then looking at seasonality, December tends to be the third best month of the year. I also added another line here where it says most of the January effect, if you've ever heard of that, it takes place in the latter part of December. And this is where people might start to favor small caps. So usually in about the middle of December going forward into the beginning of the new year, a lot of times this is when we see small caps really improve. But when we look at the S&P and the major indexes for December 4th, we are negative with the Dow, we're neutral to negative with the S&P, and we're neutral to positive with the NASDAQ. So we kind of get a whole mix there. Here's another chart. Now, this is the Russell 2000, which are small caps, divided by the Russell 1000, which are large caps. And this shows that on a historical basis, from 1979 to 2022, the small caps tend to outperform. And there's a lot of people looking at this. So this may give some support to small caps that we really haven't been seeing all that much in the latter part of 2023. We will be on the second trading day of the month, where we do see a little bit of an improvement here with the green dash line. That's during a pre-election year. And we're pretty much, well, I can't even see the solid green line in here, so it doesn't seem to show anything that special. And then here's another one. It says, remember, Santa tends to come later in December, where it's usually about the middle part of the month before we really start to see things take off, according to this research. So we might see some weakness in the earlier part of December. At least that's what has happened historically from 1950 up to 2022. Here's our other chart, kind of suggesting that even during a pre-election year, where we might see some weakness in the earlier part of December before we see some more strength. Also, some potential weakness as we get into the latter part of December. And also, this could be the area of weakness that we're seeing here before we see some strength later on in the month. Also, kind of chopping around here, but this might be the area of some weakness before we see some strength. Carson, also, at some point, we're going to get beyond their historical measurement here and get into the period that tends to be more positive. We also see a little bit of a pullback with the equity clock chart before we see some more strength going into the end of the year. Now, that's just seasonally, and that's historically what has happened. Anything can happen, but we look at all these different charts. They're kind of telling us the same thing. And so that gives us a little bit of confidence as to what we think will happen going forward. Looking at the Stock Traders Almanac statistics, we're now into December for the NASDAQ, where we go a little more sideways before we see some strength going into the end of the year. Kind of seeing that same thing with the S&P. That's the green line. So what's our scenario situation for Monday? We're not going with the down one. Yes, we are overbought. Yes, the market probably should be falling. The only problem is it's not. And to try to front run this, I like to wait for evidence to suggest that we're actually turning negative. Now, there's always warning signs that we can latch onto, but until we see it actually follow through based on price, we still have to lean more towards the up scenario. We don't want to go with the sideways trend right now because both of our ADX charts suggest that we are in a trending environment. The warning signs, we're still keeping an eye on this risk on, risk off posture. It is showing some improvement, but we want to see some follow through. The momentum oscillators are starting to get extreme. This is a new addition to this page here, with some beginning to roll over, specifically the short-term oscillators that we look at, the slope oscillator. And the Copic curve has generated a sell signal a couple of days ago, but we're still dealing with longer-term downtrends with the small caps, the Russell, and the mid caps. Positive signs, the daily special K chart is positive. The weekly chart is negative. I'll be covering the weekly chart in the weekly video. And this is, I just have to go based on what we saw last time here, the 5-period equity put call ratio, as well as the 253-period equity put call ratio. They're both going down, and that is shorter term and longer term positive. But we're still looking okay with our oscillators, with the S&P and the NASDAQ 100, but we're seeing some rolling over occurring. So just be aware of that. The parabolic SAR and the vortex charts continue to be positive. The bullish percent index, it's still looking really healthy and not extreme for right now. Small and mid-cap growth, chopping sideways, but continues to be positive. The financial sector is seeing a little bit of love these days, and we're seeing some back-to-back actual gains in that sector. And the 50-period exponential moving average study that we do with the new highs, new lows, it is positive. So our conclusion, same thing that's been on here for about a week now. We are positive. We are overextended. Could weakness be starting to develop? We're not seeing any real proof of that yet based on price, but we want to be aware of that. we see that same thing in the short and intermediate term where we're still positive in the long term. Thank you. I will be preparing the weekly video, the intermarket analysis video, and the deep dive video. I'll post those just as soon as I can over the weekend. I hope that you have a really nice weekend, and I will talk to you in the next video.